This could be the biggest, most impactful week of all of 2024. I can't recall any time we've had this many large events in a single week ever. It's almost mind-spinning the amount of new information that we are going to get. I'm going to do my best to break all of this down for you and my expectations and ultimately how this could affect our markets and specifically Tesla stock. I know I say it all the time, but this time most certainly is true. The work is cut out for us here in this video, so let's get started. So there are three major themes, if you will, of this week. Number one is the Fed. Number two is big tech earnings. Number three is the economic data. We're going to break down all of these three independently and, well, collectively. How will they affect the markets? This week could have a significant influence to sensitive companies to interest rates, like a Tesla. First up is the Fed. Now, the Fed will be this Wednesday. We're not expecting anything to happen as far as the Fed actually cutting rates or raising rates. We're expecting a continued pause. For March 20th, it's really a coin toss between a rate cut or a continued pause. Currently, the markets are expecting a continued pause, which is bullish because it's not like we're expecting a rate cut in March and the Fed's going to push back on that. If the Fed pushes back on a rate cut for March, that's already what the markets are assuming anyways. So there could be an upside surprise there if the Fed does indeed want to cut rates in March, like Goldman Sachs believes. Goldman Sachs does indeed expect the first rate cut in March and 5 rate cuts in total for 2024. Now, believe it or not, I don't think Wednesday's Fed meeting, the thing the markets take away from it is not going to be interest rate policy, whether or not the Fed is signaling more or less rate cuts. The biggest thing that could happen this upcoming Wednesday is potentially an end or massive reduction to quantitative tightening. Now, quantitative tightening is the process of the Fed reducing their balance sheet. Like Jamie Dimon's JP Morgan's longtime CEO just said recently, we truly don't know the effect of quantitative tightening. But we do know one thing. Quantitative tightening has a big impact on treasuries because the Fed is currently essentially selling $60 billion worth of treasuries every single month, and they are selling $30 billion worth of mortgage-backed securities every month. But coming this Wednesday, we could see the Fed actually announce an end to quantitative tightening. And what that will do is potentially drive down interest rates pretty aggressively. Now, I could obviously be wrong on this. This may not happen just yet, but the reason I think it will is because the Fed just ended their bank term funding program, which is essentially bailing out the banks and giving them par value for their unrealized losses in their bonds. The Fed is ending this program on March 11th at a time where $168 billion are currently out to loans with different banks that have bad bonds. Now, an end to quantitative tightening could cause bond prices to rise, which could alleviate some of those unrealized losses and thus help out the banks and, well, drive rates lower in the process. This could have a huge impact to interest rate sensitive companies like a Tesla, specifically the companies that have been underperforming in 2024. Theoretically as well, you can see here the percentage of stocks above their 50-day moving average is at 65%, down about 20 points from the high of about 86% we've seen towards the end of December. At the same time, the S&P 500 has been marching on to hit new all-time highs basically every single day. So what's happening is the markets are top-heavy. Magnificent Seven, semiconductor companies, well, have really fueled this leg of AI hopium that Microsoft, Google, Amazon, all of these big companies have benefited from that control the vast weighting of the S&P 500. They've been doing very well. I mean, look at Nvidia up 26%, 27%, AMD up 26%, Microsoft, Google up almost 10% just in the month of January. What theoretically happens from here is you need to see the rest of the markets catch up to what big tech has done, and then you can see continued highs in the markets, or you see a catch down where Magnificent Seven, chip companies, they fall to match what the average stock has done. If the Fed does theoretically end quantitative tightening, I think that would be very bullish for your bottom half of the markets, and potentially you could see the bottom half of the markets, interest rate sensitive names, cyclically sensitive names, catch up to big tech, thus keep the bull market going for longer. Now, this is only speculation on my part. There's nothing definitive that says the Fed will make this announcement, but that surely seems like the direction that we are going in. Could I be wrong? Maybe. Maybe we don't get this quantitative tightening ending until March 20th, but I would think the Fed would at least signal that coming this Wednesday, and a signaling of the end of quantitative tightening is likely enough to drop interest rates, Treasury yields quite a bit. Because fundamentally how this works, if you look at TLT, the higher this chart is, the lower the Treasury yield is, right? The lower this chart is, the higher the yield. So Treasuries, their prices have been falling for a while. A lot of that is due to the Fed selling Treasuries. Well, if you no longer have that selling pressure in the Treasury market, the buyers will be able to take hold and send Treasury prices higher and yields lower. It's also worth noting, if I am correct about what the Fed is going to do this Wednesday and really do stop quantitative tightening, or at least strongly signal that they are going to stop over the next, coming month or two, the next 1 to 2 meetings, that could uninvert the 2 and the 10-year yield curve. As things start to normalize, as that selling pressure is no longer in the Treasury market, you will likely see 2-year Treasuries fall more than 10-year Treasuries. That would have an uninversion effect on the 2 and the 10-year yield curve. Now, ever since 1950, you don't really need to worry when you're actually inverted on the yield curve. It's when you uninvert on the yield curve, that's when the problems start to actually happen. You tend to get the inversion, and then you come out of it, and then you're either in a recession or very shortly thereafter heading into one. Even back to 2019, you inverted on the yield curve in August, September, towards the end of August. And then what? By March, you were in the Rona recession about 7 months or so later. And not a lot of people had a thought about the Rona causing a recession at this time. So, yeah. Maybe the markets would be fearful about this upcoming week if that were to happen. So a summary here for the Fed. I do expect the Fed's going to be more positive than negative, especially for your bottom half of the markets that have not been participating as much as the top half. Think interest rate sensitive names. Think a name like a Tesla could benefit quite a bit from the Fed stopping quantitative tightening. Next up is earnings. You're going to have a bunch of earnings. Now, I'm not as optimistic about earnings as I am the Fed. And ultimately, earnings are going to matter more than the Fed. At least they should in theory. So Monday, you're going to have SoFi and Supermicro. Supermicro is your top company in the Russell 2000. It's going to affect your interest rate sensitive names. But other than that, there's not too many notable names to speak of. Tuesday pre-market, Pfizer, GM, UPS, JetBlue, Marathon, MSCI, HCA Healthcare, and Pulte Group. GM could affect Tesla depending on if they, have negative things to say about the EV market. I'm sure they will. I would go out on a limb and say that's already priced into Tesla stock at this point, that if anything, good earnings from GM could be a positive catalyst for Tesla. Now, also keep in mind, we are going to get weekly insurance registrations numbers coming out Tuesday pre-market. That, as we expect, could be a good number, and that I would imagine would have a big positive effect on Tesla stock. Since Tesla did not give us formal guidance, any of these registration numbers that we get are going to have outsized positive or negative effects to Tesla stock. I think we're probably going to get a good number, so Tuesday could be a good day for Tesla. Tuesday and after hours, we are going to get Microsoft, AMD, Alphabet, Starbucks, Skyworks, Juniper Networks, Match Group, Lending Club, Electronic Arts, EA, and CP. Dan Ives writes on X today, we believe Microsoft will be the most important earnings report and conference call, Apple being number 2, in all of earnings season, regardless of the sector, as the launch of the Copilot rapid success / early adoption of AI will have all eyes of the street. Big week ahead for tech. Now, when it comes down to it, I don't think earnings are going to be bad or terrible. I just think the expectations are too high. Microsoft, AMD, Supermicro, these names that are AI related or semiconductors, they're already trading at all-time highs. They've already seen some massive gains, well, the back half of 2023 to start 2024. Could this be the point you actually see a correction based on high expectations and an under delivery on earnings, longer to develop potentially the AI story than what people are expecting? Could that happen? Yes, but specifically semiconductor companies like Supermicro and AMD, I think they are almost certainly set up for disaster, like Intel on Friday, dropping about 12%. Now, Wednesday is going to be the slowest day of really big tech earnings. You're going to get Boeing, Novo Nordisk, Phillips 66, Roper Technologies, MasterCard, Thermo Fisher Scientific, Boston Scientific, MI Homes, and Market Access in pre-market, and then Qualcomm, Corteva, Align, Wolfspeed, Aflac, a bunch of other companies that really are not going to matter to the broader markets. Qualcomm can be important for Apple because Qualcomm is a major supplier to Apple, so markets definitely want to watch that one, as well as Boeing. A couple of these other names like MasterCard are also important, but not nearly as important as what we have in store for Thursday. Really, Wednesdays all going to be about the Fed. On Thursday pre-market, we get Altria, Royal Caribbean, Peloton, Enterprise Products Partners LP, Merck, SiriusXM, Cardinal Health, Honeywell, Tractor Supply Co., and Stanley Black & Decker. Now, just a side note, if you guys want to see this chart, I shared it on X, and I'll go ahead and share it again just so you guys can see it. If you go ahead and follow Michael Tyler, it'll be right there on the front page. Highly recommend you guys keep this up because it's a lot of earnings, and you're definitely going to want to come back and take a look at this. If you guys also want to come trade some of these earnings with us as well, every time I make a trade and my specific earnings strategy, well, you'll get notified, and I will provide a thesis on why I am making this trade, what I plan to do, so on and so forth. We tend to be pretty successful with these earnings trades about 80% of the time, so check that out if you guys have not already. Link down below in the description of this video. Thursday and after hours, we will be getting reports from Apple, Amazon, and Meta. Same is true there. These stocks trading near or at all-time highs as of Friday. You could be set up for disappointment, even with good earnings that could be already priced in. Just so you guys know, we're looking for about 5% EPS growth for the S&P 500. A lot of the S&P and a lot of S&P earnings are these companies right here. This is over 50% of the S&P 500 that will report earnings this week. So we'll have a pretty good idea of if 11% EPS growth is too high of an expectation, or if, well, maybe it's not high enough, if somehow companies can pull a rabbit out the hat. We'll have to wait and see, but 11% is high for any normal year. And then Friday, you're going to get Exxon, Chevron, Bristol Myers Squibb, AbbVie, Cigna, Regeneron, Charter, CBOE, AON, and Grainger. So overall conclusion here is I'm expecting a mixed bag across the board, but not terrible earnings overall. I think the expectations are too high, so definitely could be set up for disappointment. We do have some economic data as well this week. Dallas Fed Manufacturing Index for January expected at -23. Last month was -9.3. A big collapse there expected on Monday. On Tuesday, you're going to get a lot of GDP data coming out of Europe, but JOLTS job openings at 10 o'clock in the morning, expecting a reduction of about 100,000. Now, this is interesting because you don't want to see JOLTS job openings plummet, but you don't want to see them rise all too much, because more job openings means likely a stronger economy, likely a stronger labor market, not as much pressure on the Fed to start lowering rates. If you see job openings collapse and fall, let's say hundreds of thousands of jobs, that means the labor market, the economy may be slowing a lot faster than what we were expecting. Now, Wednesday, mainly all going to be about the Fed, but you are going to get the ADP Thursday's actually the ADP employment change, so not much there for Wednesday. Thursday, the ADP employment change will be coming out, and you are expecting, let's go ahead and see, there's so much here to to run through. Nope, actually the ADP employment change is on Wednesday indeed. My apologies. Expecting 130,000 job ads. That's the closest thing we have to the government's report. So you are expecting a slowdown here, but still a pretty sizable number. I find that interesting for January because there's normally a lot of seasonal hiring in November and December, and then a lot of seasonally, layoffs that occur in January. So I'm interested to see how that number does come in. And then on Thursday, you will be getting the ISM manufacturing PMI. A lot of funds and banks are waiting for this number because what we've seen from a lot of the manufacturing indexes so far in 2024 is big declines. Could that have been due to weather or something else, or is it actually manufacturing just plummeting like these indexes are suggesting? On Friday, your big data will be coming out. Non-farm payrolls for January, expecting 178,000. We're going to get a revision to last month. The last 12 months have been downward revisions. That tends to happen as the labor market is weakening, as you are potentially heading into a recession. So I'm expecting a big revision for last month and potentially this month to come in a little bit on the lighter side, maybe 150,000 job ads, but not in utter collapse as well. The unemployment rate is expected to tick up from 3.7% to 3.8%. As far as the economic data, I don't have a lot of opinions here. Besides, it could just cause a continuation move. If the Fed is good, if earnings are good, then I don't think the data is going to necessarily derail that because I don't think it's going to be all too bad or all too good. I'm pretty neutral on the data for this week. Now, for Tesla stock specifically, I'm actually pretty dang bullish. You are at a record oversold for Tesla stock with an RSI still of 18.20. I think there could be a lot of bounce for Tesla if Tuesday's numbers are good for insurance registrations out of China, as well as the Fed on Wednesday does signal an end to quantitative tightening. That's going to be huge for a stock like Tesla, and I wouldn't be surprised to see a 3+% move coming on either Tuesday and or Wednesday. I think the real question is, do your semiconductors fall? Do stocks like Microsoft that are really trading on AI hopium, does that AI hopium actually come through to some earnings? And is Microsoft seeing good results with their new Copilot program? Those are the things that I think could be a little bit on the troublesome side for our markets, but I wouldn't be surprised if you see the S&P actually fall because maybe big tech falls, maybe semiconductors fall, but maybe your interest rate sensitive names do very well this week. I think that is also a reasonable conclusion. This week, option activity is actually skewed towards the call side. Out of the total open interest, 58.61% of it is to the call side. Open interest to the put side is 41.39%, so there is more calls than puts. If you look at the most active calls, you do have the 190 call with 22,000 for open interest, 50,000 for volume on Friday, and the what looks like 187.50 call with about 22,000 for open interest and about 44,000 for volume on Friday. Next up is the 180 put, 17,000 for open interest and volume of 56,000 on Friday. 170 put, open interest of 18,000 and volume of 37,000 on Friday. And the 165 put with open interest of 17,000 and 28,000 for volume on Friday. So face value here, it looks like more activity to the call side, but still the puts are pretty much neck and neck up here. Some, people in the market suggesting Tesla could rally as high as 220 this week with open interest of 21,000 and volume of 7,800 on Friday for the 220 call, and the 165 put, potentially as low as 165, as high as 220. That's a broad range that options are potentially suggesting. In my personal opinion, if things are bad, you do have a gap fill down to about 170. That would be a decline of about 7.4% from here. I don't think that is going to happen though, but that would be more like a worst case scenario if all went bad. Now to the upside, I think 195 should be pretty achievable. That's upside of about 6.77%. If things are really good, a target of about 205 would be in order. That would be an increase of almost 12% from here. Considering the RSI is still at 18, it's going to take at least a 5% move just to get back to normal on the RSI, let alone to get, to 35 or 40 on the RSI, which is still towards the negative side. I mean, you'd probably have to rally to about 200, 205 just to get there on the RSI. So I am pretty dang optimistic for this week. I would put a reasonable target around 200 for Tesla stock. That would be an increase of about 9.5% for this week. But again, that is all things considered. If we do get good insurance registration numbers on Tuesday, if we do get better than expected earnings, and we do get potentially an announcement to an end of quantitative tightening. Let me know what you think about all of this information down below in the comment section. What is your price target for this week? And I know if you guys look down there, you're going to see a lot of people 150, 160, 170. That's precisely why I'm so bullish right now on Tesla stock and the prospect of a bounce, because well, everyone's expecting a continued fall, and typically not everyone is correct. The general consensus is usually not the right one. So let me know what you think about this information down below in the comment section. If you guys want to come trade this volatile market, come trade these earnings with us, hopefully hit some big home runs, check out that link down below in the description of this video. You guys have a fantastic rest of your day, the rest of your weekends. Go Lions, baby, and I will see you in the next one.